They took their best shot, they fired the biggest weapon in their arsenal, and they missed. For 40 years, the silver market has lived under the threat of a single terrifying acronym, the CME, the Chicago Mercantile Exchange. We've been told over and over again that the exchange controls the price. We've been warned that if silver's value climbs too quickly, the exchange will just rewrite the rules, jack up the margins, and compel speculators to dump their holdings. We witnessed it in 1980, when the Hunt brothers were obliterated by sudden rule shifts. We saw it in 2011, with 5 margin increases in just 9 days, plummeting the price from 50 to 30. We experienced it again in 2020. The margin hike is the ultimate weapon, the nuclear option. It's the system's blunt declaration that the surge is finished. Yesterday, Monday, January 12th, the system detonated that bomb. They boosted margins by 15%. They inflated the cost of maintaining a contract by almost $6,000. They pulled every lever to orchestrate a meltdown. But today, Tuesday, January 13th, 2026, we're staring at a chart that shatters every financial history lesson. Look at the screen. Silver isn't crumbling. It isn't stagnant. It's holding at $88.95. That's up $3.78 for the day, a nearly 4.5% surge following a brutal margin penalty. This is the epitome of a botched takedown. The banks aim to slaughter the rally. They hope to wake up to a blood-red chart, sparking a mass exodus. They craved a leverage purge. Instead, the market eyed the margin hike and chuckled. This unyielding strength is the most potent bullish indicator we've encountered. When a market brushes off dire news, it's a bull run. When it dismisses a blatant regulatory assault, it's a super cycle. We're beholding the dawn of the Teflon market. Nothing adheres to it. The suppression strategies that dominated for decades are ricocheting off the shield of genuine physical demand. To grasp the enormity of this event, we must dissect the mechanics of the thwarted crash. Yesterday, as the announcement hit, we observed a brief plunge. The price dipped to $83.50. That was the algorithms kicking in, the timid traders folding. For roughly 4 hours, it seemed the banks had triumphed. It appeared they'd locked the price below $85. But then, a miracle unfolded. The dip buyers emerged. Who dares to buy during a margin storm? Who stands defiant against a regulatory juggernaut? It's not the Reddit retail crowd. They're petrified of margin demands. The force that scooped up at $83.50 is indifferent to margins. It's a force that deals in cash. It's a force that claims the metal from the exchange and vanishes it forever. This validates our core argument. The paper market's grip has slipped. The margin hike targets only leveraged traders gambling on price swings. It spares Samsung. It ignores the Reserve Bank of India. It bypasses the Chinese solar producer. If you're acquiring physical silver for real-world applications, a Comex margin week is mere background static. In truth, it's a boon. It temporarily slashes the price, letting you stockpile at a bargain. The banks unwittingly discounted silver for the exact players emptying their stockpiles. They're nourishing the monster there, desperate to weaken. And observe the rebound. It wasn't a sluggish climb. It was a sharp V-shaped blast. We rocketed from $83.50 to $88.95 in under 24 hours, a $5.5 leap from the bottom. This signals the tension is wound tighter than before. Each downward shove triggers a fiercer snapback. Volatility is surging upward. Now, we're teasing $90. $88.95 is practically $89, and $89 is a whisper from $90. $90 marks a milestone. It signifies nearly doubling from the $50 breakout. It's where mainstream finance media must acknowledge the saga. But beware the snare here. I must caution you, when a market turns Teflon, shrugging off hikes and attacks, it lures perilous funds. It draws the momentum hunters. It summons the fleeting capital. Open interest is swelling once more. Speculators are flocking back, convinced of invincibility. This primes us for turbulence. The bank's initial hike flopped. Will they quit? Absolutely not. They'll probably escalate soon, maybe tomorrow, perhaps Friday. They could push requirements to 20% or 30%. They'll persist until a fracture appears. But contrast 2011 with 2026. In 2011, silver abounded, vaults overflowed. The crunch was speculative fiction. Today, vaults are barren. Yesterday's data revealed 2.2 million ounces vanished in one day. Hike margins to 100%, ban leveraged futures outright. But if Samsung demands 10 million ounces for batteries and only 5 million remain, the price skyrockets endlessly. Margins can't conjure metal. The bungled strike at $83 unveils the establishment's frailty. It reveals the emperor's nakedness. The CME unleashed its arsenal, the haze lifted, and the silver bull stood unbowed, mightier than ever. This ignites a mental cascade. The shorts, the banks, are now paralyzed with dread. Their top weapon fizzled, they're exposed. This terror prompts covering. Signs emerge that commercial banks are yielding. They're not halting the surge anymore, they're fleeing the inferno. They're repurchasing shorts at $88, fearing $188 next week. This is a pristine short squeeze, the oppressors in frantic retreat. As part 1 wraps, the takeaway is stark. The system retaliated and faltered. Silver sits at $88.95. The trajectory is steep, resistance vanished. If banking dominance was the sole narrative, we'd die $100 soon. Yet a dual squeeze unfolds, deeper and thornier. While banks exhaust paper rounds, miners deplete actual. Or, in part 2 of this exploration, we'll probe futures market secrets. We'll unpack backward rolling. It's jargon, but it signals physical frenzy. Evidence shows traders shelling out premiums to skip ahead. They're ditching March for January, fearing March's silver famine. The banks couldn't halt the climb. Now miners falter on deliveries. This double vice is tightening fiercely. If part 1 covered the clamor hikes, headlines, swings, part 2 dives into the essence. The clamor distracts. The essence they conceal. While media fixates on $88 as potential froth, futures sleuths scrutinize CME open interest reports. They zero in on March delivery holders' actions. In a balanced market, futures hum predictably, rolling forward, hold January but skip physical. Sell it by March, defer the obligation. That's the half-century playbook. But Friday through today, Tuesday, January 13th, the pattern shattered. We spotted backward rolling, dig into CME minutiae. March 2026 silver open interest dropped 450 contracts, routine closures. But where? Forward to May or July? No, backward. January 2026, now in delivery mode, rose 135 contracts. February gained 50. Net, about 355 contracts fled March for January or February. Physically, that's 1,775,000 ounces, nearly 2 million cutting in line. Picture queuing for a hot gadget. Your March ticket secures one, but rumors swirl. March shipment axed, factory halted. What next? Bolt to the front. Bribe a today ticket holder to switch. Leap from future to now, distrusting delay. That's Comex now. Industrial giants and savvy wholesalers I march as a void. They foresee force majeure, recall depleted stocks from part 1, and freak out. They cough up fees, commissions, storage to snag receipts immediately. This line jumping screams physical scarcity, abundant supply. No early grabs. Storage, insurance, security all cost. Early delivery only if non-delivery risk trumps holding expense. It's the bird-in-hand play. An ounce secured beats 10 promised in March. Delivery notices, 170 more for January. These aren't spec plays, they demand metal. Typically, delivery months see open interest plummet as exits mount. Here it climbs amid deliveries, draining tub yet more dive in. This clogs delivery pipes. Warehouses ship out, but fresh demands flood for instant claims. The 1.7 million ounces backward rolling snaps the just-in-time chain. Trust evaporates. Trust exchange. Roll forward. Trust miners. Roll forward. Trust system. Roll forward. Backward move. Distrust vote against exchange viability. Why this March terror among pros? What supply intel eludes retail? The silver stream parches at origin. Reports tie to ghost supply. Miners straining on pledges. Refining maxed. Latin strikes loom. But backward rolling hints acute crisis. It implies the float London-New York shuffle vanished. Normally, New York dips. London ships. London low, Zurich aids. Global slight. Now shells empty. Shanghai's pull, as noted, vacuumed Asia ward. No March bailout for New York. Traders spot manifests, bear vaults, fear cash settlements over bars. Comex rule, undeliverable. Cash out, for speculators, maybe gain. For industry calamity, can't assemble batteries with checks. Can't panel solar with transfers. Samsung CRAV's metal, Tesla too. So backward rolls, grabbing physical pre-cash settlement decree. Hence $89. Not mere bets, but certainty premium. Buying silver means buying possession assurance. Evading futures counterparty risk. Paper physical gap narrows violently. Paper chases physical buyers. Urgency. Leverage note. Part 1 ease high came leveraged longs flush. But backward rollers? Cash funded, unshakable, unfrightenable. Mission. lock strategic stock. This 1.7 million ounce shift is proof the squeeze bites. It debunks Reddit bubble myth. It's a bank run by global titans. So our stance? Banks smash flopped. Physicals Q jump for now delivery. Inventory hemorrhages millions daily. Double squeeze. Banks pinched high by price shorts bankrupt. Miners pinched low by demand can't extract swift. Midway, price soars. $89 today's panic balance. But January expiry. February roll? If 2 million more jump next week, lockdown, warehouses barren of assignable bars, enter force majeure, exchange emergencies, liquidation only trades. Not yet, but data edges us nearer daily. Backward rolling, quakes precursor. Next part 3, miner drought. Why can't miners flood Comex salvation? Geology, grades, timelines, banks impotent, exchange 2 miners as we'll see, equally helpless. Silver's depleted, market prices in zero. We've probed bank suppression flop, trader Q panic, to fathom 89E's steadfastness, upstream, mines, textbook econ, high prices heal high prices, soar to $89, miners ramp, flood supply. Price dips, supply-demand dance, but 2026 silver torches that text, supply inelasticity reigns, no price spike yields quick output surge. Why? Geology first, silver's oddity, unlike gold's dedicated digs, 70% plus byproduct from lead or zinc or copper. Byproduct snare, lead miner in recession global now lead demand tanks, cut-ops, fewer workers, less rock, thus less silver, irrelevant if silver $89 or $500, lead crashes. No expansion for silver scraps, so when world begs silver, production engine sputters from industrial slump, supply curve flips, higher silver met with less yield, worse, mine silver's path. Once, Mexico miner to refiner, bars to London or New York, Comex stocked, that stream diverted, reports, Minegate mega deals, ghost supply, Peru miner CEO, usual Comex via trader, but call from Samsung SDI or Chinese so. Offer, full output next 2 years, spot plus 5 premium, we ship to our factories, skip Comex, accept. Guaranteed cash, no hedges, slam dunk, global impact. Shadow stocks, mined but siphoned private pre-public, invisible to Comex or London reports, to NYC trader, output zeroed, explains part 1 drain, no replenishment, supply privatized, silver nationalized or corporatized, force majeure whispers, miners prepping to ditch bullion bank deals, claim, can't deliver your shorts sold to industry. If so, shorts doomed, can't source from mine or vault, only from investors you. Double squeeze, banks price pummeled, miners diverting metal, timeline, 10 to 15 years new mine from find to flow, discover silver peak today. Output 2036, but data screams now need, January or February, temporal rift, demand instant, supply decade lagged, gap. Price bridges, price must crush demand, halt jewelry, melt heirlooms, but industrial inelastic, Samsung or military unstoppable, so price to extremes, forcing monetary dumps at $89, selling. No buying, retail hoards, price inadequate yet, minor drought underpins bull, bailouts fix banks, rules margins, geology defies presses. Hike failed, market scoffed, cute but metal. Metal grounded or China bound, resource nationalism dawns, Mexico or Peru watch spikes, expect taxes, bans, nationalizations each speech adds $1 premium, ghost supply real, silver ghosts from view, Comex clutches unfulfillable paper, final part, endgame, blend chart toughness, roll panic, drought project targets, $90 near, $100. Next, but if miners dry discuss triple digits, absurd now, inevitable later, banks botched, miners barren, public ravenous, storm hits, we've reached the summit. We've vivisected the margin misfire, where hikes glanced off like stones on armor, we've decoded the backward roll frenzy, institutions premium paying to front run, we've unmasked the minor drought, supply river rerouted by corporates pre-ocean, proof piles, forensic, irrefutable, not anomaly or blip systemic price mechanism collapse. After 50 years, double squeeze peaks, banks ceiling trapped, miners floor bound, price solvent, now forward gaze, post all-time high, price discovery, uncharted void, no stops. $90 cap? $100 ditch dollar gauge elastic rubber, measure vs gold or silver kin. Gold today, $4,631, up $26, new systems bedrock, gold-silver ratio, historic 15:1, crust echo, Roman to constitution, manipulation era, 81001, silver cheapened to byproduct. Now, gold $4,631, silver $88.95, 52:1, ratio shrinks, mean reverting, 215:1, $4,631.15 equals 308 as $308, $88. Bargain 70 off monetary fare, catch-up play, algos or centrales no, gold pricey, silver draws as everyman's gold, bigger bang, $100 inevitable, not if but when, $88.95, 89, $90 mind hurdle brief snag, momentum rolls, breaches soon, $100 true wall, round figures magnetize media, $100 cross. Frenzy. Economist cover, news lead, cabbies or grandma's query, public mania onset, peril or opportunity max, shortage morphs bubble, bubbles lucrative, wild, exit plan, euphoria at 25-30 buys, 200300 gains, tempt, mortgage payoff, car, trip, caution, sell $4. Swap appreciating hard for depreciating soft, cure for ailment, dollar doomed privilege fading, hikes, backwardation, drought, currency reset harbingers, history, Weimar or Zimbabwe or Venezuela early sellers rude, millions bread bound billions, sell when? Swap ounces for yield hard, ounces 2 acres, not paper land, rentals, biz, energy. Wait mania peaks, real estate cheap vs silver, now 5,000 ounces house. Peak, 500 ounces historic, generational wealth swap, fiat skip, not yet 89 launch, ratio 52, 1 aim 30-20, 1, week ahead, finances longest, volatility gut-wrenching, banks 15% flop no surrender, expect 20/30th hikes, hunt style limits, but today's lesson, hike ignored by physicals, repeat, dip, savage rebound, why? Can't margin scarcity, regulate geology, stop rise? Mine more but part 3, mines maxed, inventory diverted, price must ascend, demolish demand, to Samsung halt, solar crash, at $89, demand ramps, price undervalued. Double squeeze, financial physical collision, you holder, clutch survivor amid ruins, don't shake, fortify kin, beyond riches transition survival, dust settles, new system, your seat secured, banks defeated, miners void, public stirs, trend vertical, ally, real money era dawns, subscribe.